Investment trusts are publicly listed companies that pool money from clients and invest that money in a variety of underlying assets. Investment trusts are closed-ended, which means they have a fixed number of shares. Shares in the trust are traded between investors on an exchange during market hours, usually through an investing platform. This means the trust manager has more discretion over when to buy and sell underlying assets than managers of open-ended funds, which trade to accommodate investors' money flowing in and out. Because the shares are traded on an exchange, their value can change according to market sentiment. When investors feel positive, then the trust may trade at a premium to the value of the underlying assets. If demand is low, the shares may trade at a discount. Discounts can offer opportunity over the long term. Trusts can also borrow money to invest, allowing them to put money into underlying assets. This ability to borrow, known as gearing, can amplify investors' gains when markets are good, but also amplify losses when markets fall. The higher the gearing, the larger this amplification of potential gains and losses. This potential volatility, together with the difference between share price and the net asset value of the underlying assets, means that investment trusts are usually considered to be for experienced investors who understand the risks well. That is why it's always important to read the relevant fund fact sheet to ensure you're familiar with the risks. So there you have it. We hope you found this video useful. For more information about Fidelity, visit fidelity.co.uk.